What's up, YouTube, and welcome back to another episode of Finance and Freedom. My name's Todd, and today we're diving into one of the most powerful and underrated strategies for generating income in the stock market: selling covered calls. Now, if you caught last week's video, I broke down how you could make an extra $90,000 a year by selling puts. If you didn't see that one, seriously, go check it out and check out that video, because these two strategies kind of go hand in hand. Actually, they definitely go hand in hand. Here's the deal. When you sell puts, eventually you're going to get assigned those 100 shares. And when that happens, most people just sit on them hoping the stock recovers. But you're actually leaving a lot of money on the table when you do that. So today, I'm going to show you how to use covered calls to not only get rid of those 100 shares, but also make even more income while you wait. Let's get into it. Before we get too deep, let's do a super quick recap on selling puts so everyone's on the same page. When you sell a put, you're promising to buy 100 shares of a stock if it drops to a certain price, a price that you pick. And for making that promise, you get paid. And that payment is called a premium, and you get to keep it no matter what happens. Now, if the stock never drops to that level, guess what? You don't have to buy it, and you still get to keep the cash that they paid you. It's like getting paid to wait for a discount. Pretty sweet, right? So eventually, one of those puts will get assigned, meaning you'll have to buy 100 shares of that stock or ETF. Now, that's not necessarily a bad thing, especially if you follow the strategy that I laid out in the last video. Again, you should go check that one out. Now, you don't have to be worried because you're buying a great company at a great price. And that's exactly where covered calls come into play. So what exactly is a covered call? Well, a covered call is basically the flip side of a put. Instead of promising to buy 100 shares at a certain price, you're promising to sell your 100 shares at a certain price. And just like before, you get paid a premium to make that promise. It's pretty great. Now, here's the key. You want to set your strike price higher than what you paid for the stock. That way, if the stock gets called away, you're selling it at a profit and you basically collected income from that premium. It's like getting paid twice for doing what you already planned on doing anyway. And just to be clear, you must actually own those 100 shares in order to sell a covered call. That's why it's called covered. Now, there are advanced ways to sell calls without actually owning the shares, but that's a topic for another day and another video. So let's run through a real-world example. Let's say the market's been really rough lately, which, not really hard to imagine that one. Even though you sold your put at a 30 delta, like we talked about in the last video, playing it pretty safe, it still got assigned. So now you've got 100 shares of the stock sitting in your account. And if you're like me, you might have used margin to buy them. Now, since you used margin to buy them, you're probably interested in getting rid of it fairly quickly, so you're not paying interest on that, and you're not going to want to hold it forever. So you're just waiting for the price to bounce back a little bit so you can sell. So here's where selling a covered call can be a game changer. You can sell a call on those shares at a higher strike price and start collecting income every single week or month while you wait for the recovery. Even if the stock doesn't move that much, you're still getting paid. And if it does go up and gets called away, you lock in a profit plus the premiums you earned along the way. So it's honestly one of the best ways to get paid while you wait. All right, let's hop into Robinhood and take a look at what this actually looks like in practice. All right, so last week I was assigned 100 shares of Walmart. I saw the price going down. I was like, okay, it's probably not going to go much further than that. And it did end up going a little bit further, and I was assigned to those 100 shares. Not a big deal. Walmart is a great company and will continue to do well in the future. I'm not worried about it going back up on price. So it ended up being a really good buy anyway. Now, I will say that since Walmart is not a particularly volatile stock, you'll notice that the premiums that you get for both puts and calls aren't really that high, and that's because there's not a whole lot of risk involved. The more risky the stock or the ETF you buy into, the better those premiums are going to be, and so you just pick and choose whichever fits your style of trading the best. Walmart is just one of several puts that I made, and so this is one example I'm going to use for selling a covered call today. So as you can see, Walmart actually still hasn't recovered a ton. If you look at the last week, we're a little bit up from last week, but still not doing terribly well. But I ended up, my average purchase price was 103.52. Now, whenever you're selling puts, you realize, chances are it's going to be at even dollars or at least the half mark. Well, how would it be 103.52? Well, they're actually incorporating the money that you gave or that you got from the put into the purchase price, and so it actually lowers that. So my strike price for Walmart was at 104, and so now we're still sitting at 102, so it's a little under what I paid for it. But like I said, I imagine within the next week or two it will be up well above that anyway, and we'll collect both the premium on how much we sell it for. So I'll probably sell it 105, and I'll collect the premium from the covered call as well. So let's take a look at how we do that. So you can see over here, we'll go to Trade Walmart Options. Now you can see that I'm doing this on Robinhood. You can do this on any trading platform. I just happen to really like Robinhood. The layout is really intuitive. It's just been a really good app for me. So anyway, once we get into trading options, you can see up here at the top, it's really important that you select sell and call. That's what we're working with today. If you don't do this, it's going to change your strategy completely. So make sure you hit those two buttons. Now we're going to go 2 weeks out for this one. Since like I said, the premiums for this are pretty small. If I set the 105 mark, we're looking at only 17 cents per share. Now, since it's 100 shares, because the put that I bought was 100 shares, we're looking at moving the decimal place over 2. So that would be $17 premium that they give me for going up to 105. That's not really great. It's not really worth my time doing that. So what we're going to do instead, you can see the price just went up, and additionally, because the price went up, so did the amount that I got for the covered call. So that's good to see. So we're going to set this, instead of only being 4 days, we're going to set this 11 days. So basically 2 weeks out. And you can see it changes the premium immediately. So now instead of getting the $17 or $18 that we're going to get, now I'm getting $167. So that's a much better premium just for waiting a little bit longer for the price to go up. And it seems that the market sentiment thinks that things are going to go up over the next week or two. So that's good news for all of us. Now, if you actually click on this stock right here, you can see the numbers down here, and you can see the delta. There's a 3.6 delta, or a 36% chance that this is actually going to go through. I'm less concerned with the delta whenever I'm selling covered calls than I am with puts, just because I already own the shares, and I'm just wanting to make sure that I make more than what I bought them for. You could go higher than this, you could go lower than this, you could set the price at basically what you bought them for and still end up making the money off of the premiums that you get from the puts and the calls. I like to make a little bit of money off of the stock as well, and so I like to set it a little bit above. Now, since I'm setting it $1 above my actual purchase price, that's an extra $100 that I get because 100 shares, $1 over, that's an extra $100 that I will get for owning this. So I realized in my last video that I didn't actually show how you actually purchase a put. And so we're actually going to do it today on the computer just so that you can see exactly what happens. So you can see here, we're going to click right now on the $170, and you can see the expected profit of $170. That's good. 105 call set to expire 11/21. Everything looks great. All right. And let's hit continue. And estimated credit of $170, and I get that immediately, and we're going to hit review order and submit. It's 100 shares of Walmart, and done. It really is that easy. The beautiful thing about covered calls is that you're earning multiple streams of return from the same stock. So you get the premium from the covered call, you get the dividends from the holding stock if it pays out dividends, and potential capital gains if it gets called away at a higher price. That's a triple layered income. And once you start stacking those up across multiple positions, you can build some serious cash flow. Now, this strategy does have its trade-offs, just like any other strategy. If the stock suddenly rockets higher, your upside is capped at the strike price. But for steady income focused investors, it's a fantastic way to make your portfolio work harder. So to recap, selling puts gets you great stocks at great prices. And selling covered calls helps you get paid while you own them. Together, they form one of the most consistent and reliable ways to generate passive income on the stock market. And really, that's what Finance and Freedom is all about. If you got any value from this video, do me a huge favor, hit that like and subscribe button down below and turn on notifications so you don't miss the next one. And if you're already using covered calls, drop a comment below and let me know your favorite stock ticker to run this strategy on. Thanks for watching. I'll see you in the next episode of Finance and Freedom.